Good morning and welcome. Patriot Radio News Hour. Joe and Jason here on this Thursday. Yeah, happy Halloween, everybody. Hope if you got little ones out there, be safe. Hopefully, let's just hope your neighborhood doesn't turn into L.A. Did you see anything to riot anymore? The Dodgers win the World Series as Aaron Judge. Wow. The Yankees did their best Bad News Bears impersonation, and then, of course, they burned the place down. I never really understood that, but okay. Congratulations. I'm not happy about it. The Dodgers, with a record payroll of all time, are your World Series champs, but I'm going to say this. I hope you're paying attention. Big developments happening. We got a lot of economic data out. We had jobless claims. We had inflation data, a bunch of other stuff, and none of it matters. Huge issues in the UK right now. Remember, they came out with a big tax increase. They want to spend a bunch of money. They want to redefine what debt is. And boy, the bond market is not having it. We've got sell-offs across the board, across the world, as the UK 10-year note, it's gone absolutely insane, kind of what we've been talking about, right? What is going to happen when they decide they don't want to buy the debt, whether it's our debt, Japanese debt, UK debt, right? European debt, Chinese debt. We're starting to find out. We're going to play a clip in the next segment. Jeff Gunlatz, and he's a guy I tell you, man, you need to pay attention to. He's going to lay it out for you. He's going to tell you what it is that you need to be ready for. And we keep talking about this. I don't know, did we hit the top already in stocks? I don't know. But rest assured, this doesn't end with, this, soft landing or whatever you would like to call it. We have a major, today, right, we have to refund a huge amount of U.S. debt, and of course, yesterday the Treasury came out and said, hey, we've got to, do a reissuance. We need $125 billion to get the checkbook restarted. This is how much debt we're going to issue. And oh, by the way, in the second quarter of next year, we've got to increase all the bond sizes. We got to do all this stuff. Is what's happening today in the UK a precursor to what we are going to see here? To give you kind of an example, the UK 10-year note, it's up almost 20 basis points. 10 basis points is huge in a single day. It is up 20, and it's not done, right? It just keeps going higher and higher and higher. So, when we talk about the bond markets, they're not supposed to move this way. Our bond market, we're back near the top again, right back near that 435 as we continue to watch and see how this is going to play out. But it's just concerns globally about all of this debt. Who's going to pay for it? Do the central banks have the power that they think they have? Because let's face it, let's go back throughout time. Every time that we have an issue like this, what do they do? Well, we're going to lower rates. And when we lower rates, the yields are going to come down. And then it'll be okay. We'll go, as we know, they're willing to go all the way to zero. Well, right next to zero, right? In the case of Japan and others, heck, they're willing to even go negative. But something is already broken. Don't take my word for it. Who am I? right? Don't take me. I mean, I've only been doing this 20 years, but don't take my opinion on it. Right? Jeff Gunletz is going to lay it out for you. Why do I say you got to pay attention to him? Well, because his company, right, they're huge players in the debt markets, right? They call the guy now, he's got the moniker, the bond king, right? So it's worth noting. And remember, what is the bond market? What's its job? Its job is to price risk. That's its job, right? And the Federal Reserve and the central banks, they've decided that, you know what? We don't want accurate risk pricing. See, we want to try to avoid any hiccups, right? We want to defy the laws of economics. And say, you know what, well, we can prevent a slowdown, we can prevent recession, we'll just spend more money, lower the rates, and do all this nonsense. That's what they've done. And, of course, what did that end up really get? Boom and bust. And it looks as if the bust cycle has already started. And this is the problem. When we look at what's going on, right, we don't know where, right, Jason? It could be anywhere. It could be here. It could be overseas. It could be a bomb dropped in the wrong place or somebody did that. I mean, so many things. But, Jason, the markets are on edge today. When we get back, Jason's got the clip ready for us. What is coming? And what is it going to look like? All of that. We're going to give you all the answers when we get back. 800-951-0592, Patriot Radio News Hour. Joe and Jason on this Thursday. A quick look in here at the markets. The Dow's down 450. The S&P's down almost 100. The Nasdaq's down almost 500 points. The 10-year note at 433. The only thing up today, oil and gas. I mean, that is it. Gold's down 53 right now, 27.35. Silver down $1.27. Here's the sad part. Yeah, everything's disappearing. Everything is disappearing. Platinum's down 27. Palladium's down 21. By the way, I'm out of all platinum. I'm out of all palladium. Silver now, we're down to, we just got notification today, we're down to the last few cases before they go out of stock. So take advantage. We told you. You got to do it before the election. Now what's going to happen? Premiums are going to go up. We know exactly what is going to happen out there. The British pound getting absolutely hammered today as, again, problems with the UK debt markets and the bond market they're just not going along as they used to. Get more diversified. And we keep telling you. The bond market has uninverted. That gave you 90 to 180 days. So that's what? Christmas, right? Thanksgiving, Christmas to, let's say all the way to about April Fool's Day. That's it. That's all that's what history tells us. Get up to 10.25% fixed rates of return, not correlated to the stock market, doesn't care about the Treasury market, doesn't. They don't care. They don't care. You got $50,000 or more. You got big IRAs. Start right now. Get a gold and silver, take part of it. Get a gold and silver IRA, take another part of it. Get over to Y-Refi. Check them out. InvestYRefi.com. The word invest, the letter Y, REFY.com. Or just call them at 888-Y-REFI-24. 888-973-3924. So what is playing out in the UK right now? Remember yesterday, they came up, hey, we're going to spend a bunch more money. They raised taxes. And today, the bond market is like, we don't see it. We're not going to loan you money at the rate you want. If you're going, so remember, what is the bond market's job? I'll say it again, to price risk. Any good investor will tell you, you don't take risk if you don't have a good reward, right? What's the point of taking a risk if you're not going to be rewarded for it, right? Because then what happened? Well, the only alternative is what? Well, I took a risk and I didn't make any money, or I took a risk and I lost a lot of money. That doesn't make sense. Now, go to allamericangold.com. You can do this on your own. We have the full interview from Jeff Gunlach. It's right near the top. It's like the third article down, and you can hear it for itself. The whole thing's like 30 minutes. I'm going to play the most important 25 seconds, and then I'll explain the highlights afterwards. But he's talking about when the United States gets ready to enter into this recessionary period where the Fed is going to try to lower rates, and it's not going to work. So, Jason, when you're ready, let's play it. This is Jeff Gunlach. This is 25 seconds, maybe the most important 25 seconds of the year. Go for it.
So people are talking about this interest expense problem. What happens in the next recession when the deficit goes up to $5 trillion? And somebody says, I am not buying 3% bonds where you're issuing $5 trillion of them, and you're running an inflationary policy through deficit spending and no doubt, at least initially, lower interest rates. I think there's going to be the potential for a failed auction. And so one thing...
So there you go.
Now, earlier in the clip, he talked about where the debt is going to be. He said, well, let's face it, we've got experience. We know what the government does. And he's talking about, hey, this is a no-brainer, right? The debt is going to be in a single year. You know, we're talking about $2 trillion right now. He's talking about $5 trillion. He goes, because that's what history tells us. Because you're going to get way lower tax revenue. Remember, if Wall Street didn't have this great year, right, we would have been talking about a deficit over $2.5 trillion because we brought in almost $500 billion in capital gains that won't exist. Less money coming in to Social Security and Medicare and Medicaid. Government's going to spend money, $5 trillion. Inevitably, the Fed is going to lower rates, and it's not going to work. And we are going to have what he called a failed auction. We've never seen it. But boy, think about what we talked about yesterday and the day before. How many people this week, and I'm not talking guys, me. I'm not making this prediction. I'm telling you what Bank of America said. I'm telling you what Goldman Sachs said. I'm telling you what J.P. Morgan is saying. Yesterday, you missed yesterday's show. There's this board that is made up of all the big private players in the U.S. debt market. In other words, the dealers, the hedge funds, the pension funds, the money market funds, right, the foreign funds, all the big hitters. After Janet Yellen makes her a little announcement about how much more money the Treasury is going to need. And they just simply say, what are you guys doing? We're going to have a problem. The taxpayer's going to get screwed here. And it's so funny because that 25 seconds, that was 20 minutes into a 30-minute interview. Do you know what he talked about in the first 20 minutes? How wrong the data is. How complicit the stock market and the bankers are, because, well, they're like, well, but every time we do it, right, and he's talking about recessions, we just lower the rates and the yields come down. And then he started talking about this isn't happening. Fed lowered 50 basis points, the yields are up. And then he talked about the government debt. Just in the next 2 years, just 2 years, $17 trillion needs to be rolled over on top of whatever we issue. And I think we're going to have recession in that 2-year period, so you can do math. But here's the problem, he said. He said, 5 years ago, if you bought a 5-year note, it yielded 0.2%. It's now yielding 4, right? 4 and change. The amount of interest. Now, he said in this piece, we're already to 1.3. Talking about 2025, we're going to spend 1.3. And he goes, but it's going up. Every auction we have, it goes higher. Remember, Bank of America said we're going to pay $1.6 trillion next year in interest only. And he says it gets worse in 2026 because most of the debt that gets matured was issued at rates below 0.5%. But then he said, boy, and I'll say this, it's a little, I don't want to believe what he said, but he's already prepared his bond portfolio for the following. Here's what he says. It'll be impossible. We will have failed auctions. And that the government, the Treasury, and the Fed, all the quantitative easing in the world will not fix it. Again, going back to why would I take a risk with no reward? But here's what he said they're going to do. That person who's got that let's just take that 5-year note that was at 0.2. He says that he believes the Treasury will force a reissuance at the 0.2 and essentially put the loss on the bondholders. And we'll just essentially what he's saying is the United States will just simply stop paying interest. That's kind of what he's saying. Right? Or, well, I'm only going to pay the interest from the last time you borrowed from me. And then inflict, and he was saying 30 to 50% losses. Think about what that will do to the banks. Think about what it will do to the money markets and all the equity market. Forget about it. I mean, as soon as you have a failed auction, the equity market's over. Jason, it truly is incredible. And the way he does it, because he's just having a conversation. Right? He's not like me. He's not screaming and hollering and, all these things. He's just saying this is what's going to happen. So guess what he's done? He's taken, now this guy's got a bond portfolio, and I don't even know how many billions of dollars, tens if not hundreds of billions of dollars. He's got it all set up because he thinks in the next 2 years the government's going to be paying less than 1% interest on all the bonds, regardless of what the debt markets say and force the losses onto Wall Street, onto the financial institutions, and he just doesn't see, Jason, he just doesn't see any other way around, right? He's just like, what would you do? You can't have interest payments that are $2, $3, $4 trillion a year on top of going through $2, $3, $4, $5 trillion in debt a year. The math just won't work.
Unless the government can borrow it. If the government can borrow it, they can borrow $4 trillion. They can borrow $10 trillion. The government can borrow whatever is allowed to be. But I don't think the Fed wants the heat of loaning that money to the government. So this is why I think the big banks very soon in the future will be allowed to just be the irresponsible ones. I mean, look what they did with the mortgage-backed securities, the 2008 crash. This is the same
all the
thing.
laws. Broke the laws.
Broke the law. So I think Gunlatch is right. The government, the Fed, doesn't care about, who's leveraged wrong or who's paying too much. The Fed cares that the United States government gets what it needs. And so while the government's paying 0% or 1% or 2%, I think the Fed drops the rates. That doesn't mean that we're going to pay less. Our mortgage could be 10%, while the government will be borrowing at 1%. That's how you inflate your way out of the mess you're in. That's what happened during World War II, Joe.
Amen. We'll be back. 800-951-0592. They're calling this a VAR shock, what's going on in the UK. If you're just joining us, the bond market in the UK has blown up today. And what a VAR shock, it's simply put, this is like the maximum amount of pain that the market can inflict before it implodes. So this is one of those moments where I guarantee you the UK Central Bank is working behind the scenes here. People are now saying that there may be a quantitative easing may be announced in a matter of days in the UK to try to stave off what's becoming a huge problem in both the 2 and 10 year. The gilts, as they call them, are blowing out. Traders literally on top of each other as the entire yield curve pancakes. The 10-year note, like I said, at one point was up over 20 basis points. It's unheard of. You don't see these things. They're calling it one of the largest fiscal loosening of any fiscal event in decades. Wait a minute, you're talking about they've done something worse than COVID, worse than the financial crisis? I mean, the UK was affected just like we were. And the answer is yes. And guess what the bond market did? Exactly what Jeff Gunlot said was going to happen. They didn't go down. They went the other way. And the only reason they're going the other way is, Jason, is because, and I love his comment, I keep going back to it. You don't buy risk without reward. That's dumb. Right? If you're going to take a risk, you better get something good for it. Because let's face it, a risk means you could lose. They're saying that the UK budget deficit will be somewhere approaching 10%. Man, we're at like 7 to 8%. Now the UK, Jason, you can just see, here's the good part. At least, guys, at least it gives you an example. It gives you an example of what could happen. It didn't fail, at least not yet. But essentially, it's gone as high as it can go without failing. And imagine that happening here. Instead of talking about Wall Street down 400 or 500, are we talking about, hey, Wall Street's down thousands in a single day? These are the things that can happen. And Jason, it really is something that I think highlights what we've been hearing, because we've been hearing these rumors for a while. Remember Jamie Dimon? He's been talking about interest rates at 8%. And now that seems ridiculous, because we're like, well, wait a minute. He said that before the Fed even started cutting rates. But it really is now starting to make a lot more sense of what really is happening. Not enough money, right? I mean, at the end of the day, that's kind of what we're talking about. There's not enough money willing to take a risk of loaning governments money and saying, hey, I'll take 3% or I'll take 4%. That's not going to be enough. Jason, what's going to be enough? I don't know. That's the thing. Like you said. Well, how about 10%, right? I mean, could we be at that level?
Prices will be what they have to be, Joe. Prices will go where they need to go. That's all there is to it. That's why they call it a market. Now, I know the market's, when we say it's broken or malfunctioning or not working, well, it's because it's leveraged against the average guy.
Yeah,
it's not really broken. Yeah, it's not broken. It's exactly the way it's supposed to be for those that make the decision. So if we have, like I said on the last segment, if we have to pay 10% on a mortgage and the government gets to borrow at 0.5% so that they can pay for their wars and pay for their social programs and give it to their big corporate friends that want to help this guy get elected or whatever, they're going to have the money. They're going to have the money. They're going to borrow it at very low interest rates because the government's having trouble paying the interest on the debt. The numbers are getting big enough that it's scaring enough people that don't pay attention. And this is the way that they will leverage the bottom of society to pay for all of this stuff that's going on. I mean, do you really think the bankers' sons and daughters were dying during World War II? No, they sent your sons and daughters to die during World War II while they inflated their way out of a monstrous mess they created starting in 1913, Joe. That's how these things work.
And it really does. How do you get credibility back to, or linking it back to gold? Are we going to come full circle? Right? Are we going to come full circle? And everybody out there, it sure seems like that is the play. Let's buy gold, because when there's a debt market problem, boy, it just makes sense. Hey, you know what? We're going to back this issuance with gold to get people to buy, right? That just makes sense, doesn't it? Doesn't that make sense? Right? That all of a sudden, right, start waking up here. Right? We saw a shock. Let's see. We had a shock in Japan. Right? Remember? Had the shock in Japan. Heck, I don't even know if I met. Right? I don't even right. Japan. By the way, the yen, the Japanese yen back above 150, 153. Right? Remember, 150 was like the line in the sand. Yeah, that's it. Until they erase it, we'll draw another line. We do like to draw lines, though, don't we? This is the red line. Oh, wait, this is the red line. And now we talk, now it's the UK's turn. Everybody that knows what's going on, from Warren Buffett to the banks to the guys at the bond markets, they all see it coming. And of course, like Jason said, who ends up getting holding the bag? We do, because guess what? Most people don't. Not enough people listen to this show to be ready, right, Jason? I mean, that's just the reality. I mean, people really don't understand what the gold market's been telling people all year. This is crazy what gold is doing. It's absolutely unprecedented. Well, you know what? You go back to the inflation scare of the 70s, right? These are the moves that are coming. But this time, the problem is, in the 70s, the debt was only $400 billion. Now we're talking 40, 50, 60, 70 trillion, right? How big is it going to be? Take the Radio News Hour. We'll be back right after. 800-951-0592. Yesterday we had that ridiculous sale. We sold out yesterday. Here's the good news. We've got a pullback. Right now, it looks like again it's kind of like stabilized here. Gold's been hanging around like down 50, 27.38. It is again primarily driven by, we'll call it profit taking, but hey, I got to sell something I made a lot of money on to make up for all the money I just lost in the bond markets today. Silver's down a little over $1. Here's the thing. Product is disappearing. We talked about it the other. Remember, I went through the list. 1 week delay, 2 week delay, 5 week delay, out. Right. This is what we're hearing today. They're down to 5 cases of Silver Eagles. Don't know if hopefully more will come around. Remember, we're kind of entering the end of the 2024 year. So the mint is going to be shutting down here in the next, 3 weeks, 4 weeks, depend. They never have a set day, but they normally shut down right near Thanksgiving and start minting 2025s so they can, send out 3, 4, 5 million of them to start the year. Even with this is how great that deal was yesterday. Silver Eagles today, until we run out of them, $795. Remember yesterday you got them for $775. Silver's down $1. Still was better. But $795 a roll on U.S. Silver Eagles. If you buy a case of them, $790 a roll, $19,750 for a case. I have 5 available. That is it. At 800-951-0592 on the gold side. I've got some $20 gold pieces, $28.95, so below $2,900. $28.95. Again, 800-951-0592. There was so much going on. We haven't really talked about jobless claims, about 217,000. Ford is now idling production of its F-150 Lightning trucks. Lack of demand. Right now, Jason, they're going a 7-week shutdown at Ford when it comes to the Lightning. Remember, yesterday it was Stellantis, right? Hey, we're going to stop production on the Durango and all of these other issues. A big issue, by the way, Meta and Microsoft earnings weren't great. Both of them down. By the way, I don't know if this is another sign. Mark Zuckerberg just announced he's selling $1.3 billion worth of Meta stock today. And of course, stock is down. They're going to buy back more stock, and he's going to sell $1.3 billion. I guess I'll leave you to decide whether that's a good thing or not, Jason.
R. Horton.
Oh, you're good.
Am I good? D.R. Horton and Lennar, did you see? Lennar Homes. Yeah. D.R. Horton, the biggest homes. Their stuff dropped off there. Nobody's buying their homes now.
Nobody's buying. No, and yet they said new home sales were great. They're like, no. And then Supermicro. This is a company that is very involved in data warehousing, AI, and linking, I guess, these computers together. They were put into the S&P in March. Today, Supermicro says that Ernst & Young refuses to verify their financial results and has resigned. By the way, Ernst & Young replaced Deloitte, who said we refuse to verify. Their stock is down now 70%. since
like
it got put
bubble.
into the S&P in March. I don't know. That's never a good sign, right? So it looks like some fudging of numbers may have been going on at Supermicro.
Warren Buffett selling Apple, Zuckerberg selling Meta. Doesn't it feel a little bit like the dot-com bubble? Does that feel like, is that what's going to sell off big next year? Is that what's going to just blow out the doors? Because, Warren Buffett's picking up oil stocks, right? Commodity stocks.
Boy.
And he's getting rid of tech stocks.
Oil's the only thing up today. That's kind of weird. I mean,
AI,
it's only $69, but still.
AI. It's always AI. They're screaming to the moon about AI. Is this where they're getting all the dumb money to go while they slowly exit the market? And then, boom, when the dumb money wants to oh, my gosh, this doesn't look good. I better get my tech money out at a NVIDIA. And then, NVIDIA's down 50% today. Sorry, you lost a bunch of money. That sure feels like .com again, Joe. I remember the Super Bowl, the .com commercials. I remember when Kurt Warner was playing with the Rams in the 99, the 2000 Super Bowl, and .com this and .com that, and then suddenly it just all fell apart, didn't it, Joe? And that's all anyone was talking about. Get a .com, right?
Well, let me tell you this. This is Janet Yellen now says that fraud is becoming a huge problem in the banking system. I'm going to try to get some more depth on this here. Obviously, remember what happened with TD Bank, and now, of course, Bank of America admitting yesterday that they're under investigation. Man, those are strong words. She didn't say a problem. She said huge problem. You know what? You want to avoid huge problems? Call Patriot and get your gold and silver put away. 800-951-0592. Man, this is like the year of chaos. This feels like this week has been crazy. We'll be back to wrap up today. 800-951-0592. Again, U.S. Silver Eagle, $7.95 a roll today. Buy a case, save $5 a roll, so $7.90 a roll on Silver Eagles. $20 gold pieces, $28.95 at 800-951-0592. Bloomberg. So I've tracked this down. Bloomberg citing Janet Yellen now saying bank fraud is becoming a huge problem, saying that the Treasury is unleashing AI tools to come cracking down. And again, I'm just going to say this. At the end of the day, banks behaving badly results in more issues for us at the bank. Get ready. I'm sure we're going to see even more restrictions when it comes to cash and coming down the pipe from the banking institutions. Because, Jason, that's just how it happens, right? We know TD Bank, the $3 billion fine. People are starting to question, can they even afford to pay it? Are they going to need to be bought out or gobbled up, or are they going to, go the way of Silicon Valley? And now we're going to wait for Bank of America, right? Because now they've admitted to, and why do I feel like, you know what? Kind of like what we learned in the financial crisis. They were all doing it. The question will be, to what degree were they doing it? And I have a feeling that we're going to hear a lot more of this really soon.
We'll be watching it, Joe. It's sure seems like the election's going to get out of the way, and this thing's going to get going, doesn't it? It sure seems like that the timing is right here, and I would say the timing really is from here up to about March and April. This is a period where I think we see what we've been looking at the last year or two speed up, and then I think after March and April, Joe, things get real serious next year, and the inflation comes back in a major way next year.
Yeah, I think that's a really
big inflation
good observation. Yeah, I think that that for right now, they we did get inflation data out. The headline number was 2.1, but then God, we didn't even get to the economic data. And then the core was 0.3, though, and all this stuff. And we've said this for a while. They've got a few more months where just because the way they do inflation, no matter what, it's going to be like no one actually believes the data. Even Jeff Cutler can't even believe the data that they're putting out here. But, 2.1 gives them room to cut again, in 2 weeks? We're going to have a rate cut. We're going to have the election and follow that up the following week with what's supposed to be, I guess, another Fed rate cut. We'll have to wait and see what happens here because the bond markets, it's almost, remember the commercial, like the, what was it, the battery commercial where they're like, I dare you, knock it off. I dare you to knock it off, right? It's almost like the bond market is daring these central banks, right, Jason? Doesn't it kind of feel that way, that they're almost daring them? I dare you to cut rates. I want to see you do it, and then we're going to show you how the cow eats the cabbage, right? It kind of feels that way, doesn't it? Are we at the I dare you moment? 800-951-0592. Jason and I coming right back with the half-empty cup.